Most people think you need to be rich to retire comfortably. But what if I told you that investing just $1,000 a month, less than many car payments, could turn into a six-figure portfolio in 10 years? What would happen if you invested $1,000 every month into SCHD for 10 years? Would it really make a difference? Or is it just another investing myth? Well, let's find out, using real numbers. No fluff, no gimmicks, just facts. SCHD is one of the most popular dividend ETFs out there. It pays consistent dividends, has solid long-term returns, and is backed by strong companies. But what happens when you invest in it regularly over time? That's exactly what we're breaking down today. We'll look at historical data, do the math, and see how your portfolio could grow. Plus, we'll talk about the power of dividend reinvestment and how it can boost your returns even further. Stick around, because by the end of this video, you'll know whether investing $1,000 in SCHD every month is truly worth it. Chapter 1. What is SCHD? Before we dive into the numbers, let's first understand what SCHD actually is. SCHD stands for the Schwab US Dividend Equity ETF. It's an exchange-traded fund that focuses on high-quality dividend stocks. But what makes it special? For starters, it has a low expense ratio of just 0.06%. That means you keep more of your money working for you. It also pays a solid dividend yield, around 3.5% as of 2025. But it's not just about dividends. SCHD also picks strong, established companies with a history of consistent payouts. Think of names like Coca-Cola, AbbVie, and Amgen. These are businesses that have stood the test of time. The best part? SCHD offers a balance of growth and income, making it a favorite among long-term investors. Chapter 2. Historical performance of SCHD. Now, let's talk about performance. After all, numbers don't lie. SCHD has delivered strong returns over the years. Looking at the data, its 10-year annualized return is around 11.6%. That's pretty solid for a dividend-focused ETF. But how does it compare to the S&P 500? Well, the S&P 500 has done slightly better, with an annual return of about 12.9%. However, SCHD comes with less volatility and higher dividend payouts. That makes it a great choice for those who want both growth and income. Now, how about other dividend ETFs? Take VYM, Vanguard High Dividend Yield ETF, for example. SCHD has actually outperformed it, returning about 11.17% annually compared to VYM's 10.04%. The reason? SCHD focuses on dividend growth, not just high yields. But here's another key point. SCHD has held up well in downturns. With a beta of 0.88, it tends to drop less than the overall market during corrections. That's a huge advantage when things get rough. So, SCHD isn't just about dividends. It's about steady, long-term wealth building. Now, let's see what happens when you invest in it every month. Chapter 3. The power of investing $1,000 per month. Now, let's get to the real question. What happens if you invest $1,000 into SCHD every single month for 10 years? To find out, we'll use some reasonable assumptions based on historical data. Let's assume 8% annual price growth, slightly conservative compared to SCHD's historical 10-year return of 11.6%. 3.5% dividend yield, 11% annual dividend growth. Now let's do the math. After 1 year, you'd have invested $12,000, but your portfolio would be worth about $12,700. Not much growth yet, but stay with me. After 5 years, your total investment would be $60,000, but your portfolio could be around $76,000, generating about $3,000 in annual dividends. After 10 years, your total investment would be $120,000, But your portfolio could be worth $196,000 with $8,900 per year in dividends. This is the result of compounding and consistency. Even without picking individual stocks, steady investing in SCHD can build serious wealth over time. But wait, this assumes you take the dividends as cash. What if you reinvest them? That's where things get even more interesting. Chapter 4: The Impact of Dividend Reinvestment. Now here's where things get exciting. What if, instead of taking the dividends as cash, you reinvest them? This simple decision can make a huge difference. When you reinvest dividends, you're buying more shares. More shares mean more dividends, which buy even more shares. Over time, this creates a snowball effect. Now, let's see what happens after 10 years. Without reinvesting, your portfolio is worth around $170,000. But with reinvestment, it grows to about $196,000. That's an extra $26,000 just by letting your dividends work for you. Now, what if you keep reinvesting for 30 years? Without reinvesting, your portfolio could be worth about $1.2 million. But with reinvestment, it could grow to over $2.1 million. That's $900,000 more simply from reinvesting. And here's the best part. You didn't invest a single extra dollar. It's all thanks to compounding growth. This is why dividend reinvestment is so powerful. It accelerates your wealth, especially over the long term. Chapter 5: Comparing SCHD to Other Strategies. So, how does SCHD stack up against other investment options? Let's compare. First, let's look at growth stocks. These can offer higher returns, but they don't pay dividends. That means you rely entirely on price appreciation. If the market drops, you have nothing to fall back on. SCHD, on the other hand, provides steady dividend income, even during downturns. What about bonds? Bonds are safer, but offer lower returns. Plus, bond yields don't always keep up with inflation. SCHD, with its growing dividends, helps protect your purchasing power over time. Now, let's compare SCHD to other dividend ETFs. The S&P 500 has returned about 12.9% annually over the last decade, slightly beating SCHD's 11.6%. But SCHD has lower volatility and higher income generation. Compared to VYM, Vanguard High Dividend Yield ETF, SCHD has delivered better long-term total returns. Why? Because it focuses on dividend growth, not just high yields. So, SCHD isn't the only good option, but for long-term investors looking for both growth and income, it offers a powerful combination. Now, let's talk about real risks and what you need to watch out. Chapter 6: Realistic Expectations and Market Risks. Now, before you rush to invest, let's talk about risks. Because like any investment, SCHD is not a guaranteed money machine. First, market fluctuations. SCHD may be less volatile than the overall market, but it still drops during downturns. If the market crashes, SCHD won't be immune. Second, dividend cuts. While SCHD holds strong companies, there's no rule that says dividends must always go up. Some companies may struggle, which could lead to lower payouts. Next, interest rates. When interest rates rise, dividend-paying stocks can lose appeal compared to bonds. This might cause short-term price declines, even if SCHD's long-term outlook remains strong. And finally, diversification. SCHD focuses on high-quality U.S. dividend stocks, but that means it lacks exposure to sectors like tech, small caps, or international markets. Adding other investments can help balance your portfolio. So, does this mean SCHD is bad? Not at all. It's a great investment for many people. But like anything in the stock market, patience and a long-term mindset are key. Now, let's wrap it all up. SCHD has a strong track record, It offers solid long-term returns, growing dividends, and lower volatility than the overall market. Over 10 years, consistent investing could build a six-figure portfolio. Over 30 years, it could reach millions. The key is sticking with it. Market drops will happen. Dividend growth may slow down, but the power of compounding and reinvestment can help you build a real wealth over time. So, if you want a simple, hands-off strategy that balances growth and income, SCHD might be a great choice. What do you think? Are you investing in SCHD or are you considering it? Let me know in the comments. Oh, and if you found this helpful, make sure to like and subscribe for more investing breakdowns. Thanks for watching.